Welcome to Chapter 8, Recording, Adjusting, and Closing Entries for a Service Business. The essential outcomes for Chapter 8: you will complete adjusting and closing entries for a service proprietorship by A. Identifying accounting concepts and practices related to adjusting and closing entries. B. Recording and posting adjusting entries into the General Journal and General Ledger. C. Journalizing and posting closing entries into the General Journal and the General Ledger. D. Preparing a post-closing trial balance utilizing the permanent accounts in the General Ledger. E. Connecting key terms in the chapter with application. 8-2 Accounting Terminology. Permanent accounts are accounts used to accumulate information from one fiscal period to the next. Temporary accounts are accounts used to accumulate information until it is transferred to the owner's capital account. Closing entries. Closing entries are used to prepare temporary accounts for a new fiscal period. Temporary accounts need to be reduced to zero at the end of the fiscal period. Temporary accounts also follow the accounting concept of matching principle. Permanent accounts are classified as all assets, all liabilities, as well as the capital account, or the accounting equation. So all information included on the financial statement balance sheet are considered permanent accounts. Permanent accounts ending balances for one period become the beginning balances for the start of the next fiscal period. A summary: all accounts listed on the balance sheet are considered permanent accounts. Temporary accounts are classified as all revenue and expense accounts, as well as the drawing account. Temporary accounts ending balances become zero. Thus, at the start of the new fiscal period, all temporary accounts will begin with a zero balance. Summary: all accounts on the income statement, financial statement, and drawing account are considered temporary accounts. There are 4 closing entries that will be completed at the end of the fiscal period. 3 of them will be found on our income statement section on the worksheet. The first temporary account closed out will be our credits using income summary. Our second temporary accounts to be closed out will be all of our debits using income summary. The third step is to transfer net income or net loss to the capital account using the income summary. Our fourth closing entry is taken off of the balance sheet section on the worksheet. We need to close out the temporary drawing account into our capital account. The income summary account. The income summary account is a temporary account, or what you call a dumping account. The income summary account is called a dumping account because it is only used to close out the temporary accounts at the end of the fiscal period. It has no normal balance. Rather, its balance is determined by whether a business has a net income or a net loss. If the business has a net income, the income summary account will have a credit balance. If the business has a net loss, the income summary account will have a debit balance. The income summary account is used to close out temporary debit and credit accounts, as well as to transfer net income or net loss to the capital account. You will obtain the amounts for your debit and credit accounts from the income statement section of the worksheet. After all closing entries have been posted to the general ledger, the income summary account itself should have a zero balance. Closing entry for income statement accounts with a credit balance. If we look at our worksheet, in our income statement columns, we have one revenue account, which is sales. It is a credit for $3,565. We need to make this account have a zero balance. To do this, we will make sure that we are going to debit sales for the same amount. So we're going to go to our general journal, and then after the last adjustment, we will write the words closing entries centered. Then we will write the date. We will write the account to be debited, which will be our sales account for $3,565. This should bring our sales account to a zero balance. If you look at the T account, you're going to see now that it has a zero balance for sales. Then we will record our income summary as a credit for $3,565. So if you look at the T account now, we have closing revenue as a credit, $3,565. Closing entries for income statement accounts with debit balances. If we look at our worksheet, we are going to see that the only debit balances that we need to close out are the expense accounts. So to close out our expense accounts, we are going to have to credit them. Looking at the T account in the bottom corner, we are going to see that we are going to debit our income summary account for the total of all of our debits or all of our expenses. So we will write the date, write the word income summary as the account title, and then we will record our advertising expense, insurance expense, miscellaneous expense, rent expense, supplies expense, and utility expense, all as credits. Then we will add up all of our expenses, and our balance for the income summary account will be the total, which will be $1,466.
Closing entry to record net income or net loss and close out the income summary account. After we have closed out all of our debits, it is now time to transfer our net income or our net loss to the capital account. To transfer our net income or net loss to the capital account, we will use the capital account and the income summary. The first step is to write the date. In this case, we are transferring net income into the capital. Since net income increases capital, we are going to debit income summary for $2,099. This amount is taken off the worksheet under the line called net income. Again, since net income increases the capital account, we will credit our capital by the same amount, $2,099. If you look at the T accounts at the bottom, you are going to see that we have transferred the net income into the capital account, increasing the ending capital balance to $7,099. This new balance should equal the balance that appears on our balance sheet after we have calculated the beginning balance plus net income minus our drawing, which gave us our new ending capital balance. Notice also, too, that income summary now is closed out and has a zero balance.
Our closing entry for the owner's drawing account. If we look at the worksheet, we are going to see that our drawing account balance comes from the balance sheet section of the worksheet. Drawing account has a debit balance. We know that drawing account decreases owner's equity, so that means we are going to credit drawing and then debit our capital account. So let's see how this will work. We will write the date, then we will write our debit, which will be our capital account. Then we will record our credit drawing account and its amount. And now drawing account has a zero balance and the capital account will decrease by $625. Posting the adjusting and closing entries. In Chapter 4, you learned how to post journal transactions to the general ledger. In Chapter 8, you will use the same posting process for the adjusting and closing entries as you did in Chapter 4. If you need a review on posting, please go to your Chapter 4 in your accounting book. Note, the last step of posting is to make sure that you record the account number in the general ledger account into the post reference column of the general journal. This last step lets others know that the accounts have been officially posted. It is now time to do 8-2 work together. Please open your accounting book to page 212. You will need work together pages 157 through 161. These are the same working papers you used in 8-1. Please complete the assignment. If you need assistance, please let me know. After you finish 8-2, please return to this PowerPoint. Congratulations, you have just finished part 2.